Hello, everyone. Welcome to today's webinar. My name is Joe Torrey. I'm one of the investment counselors here at RealWealth, and I'll be hosting today's webinar. We have an exciting new lender to launch to the network, who has a lot of new lending options that will enable you to get more properties. So I'd like to welcome Richard Advani, who's from Southern California. There we go. All right, a couple of housekeeping tasks to go through before we get started. Our usual disclaimer. The strategies mentioned in the presentation today may not be appropriate for everyone. Other options not mentioned may be more suitable for your specific circumstances. Consult your personal accountant, tax advisor, and/or attorneys to discuss your specific situation. And as always, past performance is no guarantee of future results. Real estate purchases are subject to investment risks, including the possible loss of amounts invested. And while every effort is made to maintain accurate and current information, the possibility of errors and/or updates always exists. So this is mostly for when we do talk about properties, but even today, when we're talking about lending options, you might have even better lending options somewhere else for a specific situation. So today's educational webinar is just to give you a menu of options that you can choose from, and you can take it, compare that to other options. So Richard Advani is no stranger to RealWealth. He worked with us for many years when he was with Wells Fargo, and he did a lot of loans for a lot of our investors. But he's since left Wells Fargo and joined another bank so that he can offer our members much more different lending products that Wells Fargo is not able to. He has over 15 years in the mortgage industry and has been working with RealWealth on and off for 10 years. Here's a good thing too. He's a real estate investor himself with over 20 properties, including many out of state. So it's always good to have a lender and work with a lender who understands and thinks like an investor. His company is licensed in all the states except Hawaii. So no matter which RealWealth market you're interested in, he can finance your property. And behind him is a dedicated team of professionals, a staff with deep knowledge of real estate investing and lending. So Richard, welcome back.
Thank you, Joe. It's good to be here.
All right, I'll turn it over to you, so take it away.
Beautiful. Well, yeah, thank you for the warm introduction. As you mentioned, my team and I were at Wells Fargo for 10 years. We kind of ran an investor-specific team there. However, much like your clients, a lot of our clients were graduating over 10 loans. We're looking for more non-traditional options. So we made the move earlier this year. So far, it's been great. Here at Supreme Lending, we still do have the ability, of course, to offer conventional loans. Those, of course, are the loans that everyone's after to get the low interest rate, to get the 30-year fixed. Although now we do, of course, have those non-traditional loans as well. So going a little bit into, of course, the traditional 10 and under Fannie, Freddie loans, those are going to be generally the most attractive way for an investor to purchase a property because they are going to have those lower rates on those 30-year fixed as well. Typically, qualifications on those loans, you need to have about a 660 credit score, and we actually have the ability to go up to a debt to income ratio on those Fannie and Freddie loans of just under 50%. So all the way up to 49.99%, which definitely gives investors a lot of extra room to qualify for purchasing investment properties and make the process a little smoother as well, of course. Typically, interest rates on these programs, once again, are the lowest of what you'll find out there. But it's interesting as well because pre-pandemic, we had hit about the lowest rates we had ever seen in this industry. And what we've seen over the last year and a half is rates have dropped even more. In fact, the types of rates we can offer to investors today are about where the primary home rate bottom was. So as you can see on the slide, 25% down is going to get you in the mid threes with no points. 20% down also going to get you in to the mid 3% range, but you are going to pay a point and a quarter in that situation. So the low rates obviously are very important in this market, given that everything's appreciated. So yeah, they're super attractive right now. And if you can qualify for the Fannie Mae loans, Freddie Mac loans, that's typically the first step that you want to take. Typically for these loans, closing time frame is about 30 days to 45 days. If you're a new investor, you can expect it to go 30 days or under, given that your situation is probably going to be a little more vanilla as well. And then some other applications for the conventional loans, of course, is cash out refinancing. Given how competitive it is in the market right now, a lot of times paying cash for the property is going to get you that deal and get you in the door. And the good news is we have solutions, of course, that allow you to refinance that property you bought in cash as soon as the next day, really. You can start the process. And we can also use market value to determine the loan to value for that cash out. So if you did buy the property in cash, you got a good deal, you bought it under market value. Good news is we can turn around once again the next day, start your cash out loan and actually use the higher of what you bought it for or the true market value to determine your cash out. There's no restrictions either, of course, on what that cash out can be used for. And generally, it's the same qualification criteria as you're looking at for a purchase. You know, we're going to analyze your debt to income ratio, we're going to appraise the property, and then obviously get everything approved and closed out for you. These ones typically are also taking about 30 to 45 days to close. Competitive market that we're in. And then, of course, you know, 1031 exchanges are something we deal with a lot. It is important to deal with and work with a lender that is used to working with 1031 exchanges, just because there's so many moving parts that really happen. And especially with, you know, investors buying through RealWealth, a lot of times we're selling a property in California and we're buying 5, 6, 7, 8 different properties across the country, which, you know, once again, having a lender that's licensed in those markets, but also is comfortable keeping everything organized, because that's obviously extremely important with the 1031 exchanges. Now, as I said, one of the big reasons we moved from Wells is the ability to offer more of the non-traditional and non-conventional loan products that are designed really for investors that have either reached their 10 limit or are self-employed and are very creative with their taxes and whatnot. But for an example here, if an investor wanted to buy a $500,000 Airbnb properties, we can assist with a short-term rental loan with just 20% down. Yeah, so the rental income, of course, is calculated on these short-term rentals based on the long-term 1-year lease amount. Whereas with non-conventional loans, they actually average the rental income based on a combination of the long-term 1-year rentals in the market, as well as the short-term rentals. And we've already done a couple of these in the Florida area, and the rental income that the appraiser came up with was very impressive and very high. It leaned really more towards that short-term rental rent range, which helps, once again, making qualifications much easier for you. For this product, typically you're looking at 20% down, and that'll get you in the mid 4.625% range, give or take, with 2 points. Once again, this is the non-traditional program, assuming that you are potentially over 10 finance properties. 25% down will get that rate a teeny bit lower at 4.5%. That also is going to have 2 points with it. Now, for loan investors that do have over 10 finance properties, the product that we have right now in that 30-year fixed is, I mean, it's really phenomenal, because you got to keep in mind, as per the earlier slides, the conventional loans right now, which have hit all-time lows, are in the mid 3% range. And you can get a non-traditional loan over 10 in the mid 4% range, whereas historically that gap was massive. 4 to 5 years ago, when I first started hearing about these over 10 and non-traditional loans, the rates generally were in 7+%, and they were balloons, and they were adjustable rates. And it's awesome that the market now obviously supports these loans that have, competitive interest rates. They are 30-year fixed, so a great program across the board. Now, with these non-traditional loans, we have basically 2 different options. One of them is a full doc loan, where just like the Fannie Freddie loans, you're going to provide your income documentation and your asset documentation. We also have a no to low document program. It's really based on the rental property cash flow itself. You do need to have a 720 credit score, and you do need to own a primary home. But if you do, you can actually purchase these homes without even stating your employment information. It's based on the collateral itself, of course, and based on the cash flow of that particular property. Typical rates, once again, for these non-traditional programs, whether you're using it for going over 10 finance, or whether you're using it for the low document aspect because you're self-employed, the rates and terms are all generally going to be about the same. So you may see repetition on these rates. Once again, on that, 20% down is going to get you around 4.625 on a 30-year fixed, and 25% down will get you around 4.5. It is important to note both of those options do have 2 points, and they also have a 3-year prepayment penalty, which basically means within those first 3 years, you can't sell or refinance the property, or you can, but you will pay a penalty amounting to 6 months of interest. So important thing to note. Also, investors without W-2s, self-employed, retired people. First things first, don't think just because you are self-employed and you are retired that you can't get a Fannie Mae loan. Oftentimes you very well still can. However, if you've gone down that path with us or another lender and determined that you may be a little creative with your tax returns, or you're not quite showing all the income, this non-traditional program, once again, is beautiful because it doesn't require any personal income documentation. It's based on the property cash flow itself. And to go a little more detail in that, if the property is cash flow break even or more, meaning the rent coming in covers the principal, interest, taxes, and insurance of that property, you can put as low as 20% down with this program. However, in the market we are right now, and if you're trying to buy a property that kind of has more of a growth and appreciation potential and not as much cash flow, you could put 25% down, and we're not really concerned with the cash flow position of the property. Once again, this is really based on your credit and the property itself. So if you're self-employed, you're retired, you're over 10, it's a great option. And as you see on that last bulletin point, there's no limit on the number of finance properties you can have. We just closed some loans for a client on his 46th, 47th, and 48th finance property. So absolutely amazing product. For the longest time, especially after the recession, we were really cut off as investors on what we could do once we hit that 10 limit. And it's nice seeing the market support, obviously, people that are trying to grow their portfolio a little more. One thing to note on this low doc program is you do have to own a primary home. They want to make sure that people aren't using the program to buy a primary home using rental income and no doc, whereas they otherwise wouldn't have qualified for a primary. So you do have to own a primary home. A good portion of our investors do, so it's a great program. Once again, you need to own a primary home for this low doc program. You don't need to own a primary home, obviously, for conventional loans or the full doc programs. Interest rates, once again, I won't read them off to you guys because I know we went over them with the non-traditional program, but 20 to 25% down will get you in the mid 4% range with 2 points, and they do have a 3-year prepayment penalty. So another amazing feature of these non-traditional loans is you do have the ability to vest title in an LLC. You do have the ability to purchase through an LLC. This program also requires you to own a primary home. Generally, your credit scores need to be 680 plus. And it's important to note with this LLC loan is that the loan itself is made to you as an individual. You do personally guarantee it. However, the contract, for example, your real estate contract can and will have your LLC's name, and we will actually, through the closing process, close in the name of your LLC as well. And another great program for people looking for that extra level of asset protection, but also potentially if you're in a 1031 and you're selling a property that's in an entity already, a lot of times it may need to close in an entity. Of course, check with your 1031 accommodator. But if it does, a great program because it allows you to close in the name of an LLC where generally your Fannie Mae loans do not. So very cool program. All right, and another cool feature, and just to clarify, so this non-traditional program that we've been covering the last 4 or 5 slides, each of these slides is really an enhancement to the program. So there's not a specific program for LLC and versus low cash flow versus a short-term rental. It's the same program. It's just it allows you to vest in an LLC, or it allows you to purchase a short-term rental. So important thing to know. Now, as we spoke about, the market's crazy right now. Properties are obviously appreciating. A lot of markets have gone up, and these low rates really help in that scenario. But in addition to that, we have another product really set up for someone who knows those first 2, 3, 4 years are going to have a little lower cash flow while the rent market kind of catches up, obviously, with the increase in prices. That program that we have is an interest-only program, and it basically allows you to take a 40-year loan. The interest rate is still fixed for the duration of those 40 years, but for the first 10 years, you can make an interest-only payment. And then after 10 years, it turns to a fully amortized 30-year fixed payment. An example, obviously, to show you what that difference between an amortized loan and an interest-only loan does. If you're buying a $250,000 house with 20% down, a fully amortized 30-year fixed payment would be about $940 a month. Whereas with this interest-only program, putting the same 20% down, your monthly payment IO would be $812 a month. And I know that $128 a month in monthly savings may not sound like a huge amount, but when you're buying a property that's just about break even in those appreciating markets, it's nice to have that lower payment for those years and maybe turn a deal that you may have shied away from to a deal that may now pencil out and make sense. Generally, interest rates for these programs are just 1/8% higher than the interest rate for the non-IO. So instead of 4.625 and 4.5, they're going to go up to 4.875 and 4.75 on those interest rates. So cool option to pay 1% more on rate, take that 40-year term, take that 10-year IO. You do need to own a primary home, of course, for this product as well. And generally, credit scores need to be 680 plus. Not to confuse everyone, but it is possible to get exceptions on that in rare situations. So if you have an overall very good credit profile and you're at 675 and something's dragging you wrong, definitely still give us a call to talk about it in a little more detail. Now, of course, we have a loan product. We don't offer Flyer just because we really offer almost everything under the sun. And on that note, actually, as of this morning, late breaking news, we now have the ability to offer foreign national loans, which is cool because I've been waiting for that for 10 years. And it's funny that it's the first bulletin point, obviously, on this slide, but we do now have the ability to offer foreign national loans. You have to put 30% down on them. Interest rates are very similar to what we just discussed for this non-traditional program. It is also based on the property itself. So very cool program. Obviously, we didn't have a slide on it because we just got word of it a couple hours ago, but feel free to contact me on that. We don't offer 5+ unit loans. So for commercial properties, essentially, that's not something we can offer. We don't offer non-recourse loans. All of our loans do require you as an individual to be liable and a guarantor for the loan. And we don't offer home equity lines or 401k or IRA loans. Now, that doesn't mean you can't use your IRA or 401k and take a loan on it for the down payment for one of our loan products, but we don't actually loan to the IRA itself or 401k, which some lenders out there do. And then just kind of just to summarize, of course, we have the ability to offer Fannie and Freddie loans at those, low interest rates if your 10 finance properties are under. We also have the ability to offer cash out refinances and 1031s, whether you choose to use the Fannie Mae program or the non-traditional program that we covered. And one more thing to say on that, you don't have to be over 10 finance properties to take advantage of that program, of course. You could have 5 and just say, hey, you know what? I went full document on my last loan. I'm self-employed. I prefer to go the path of least resistance and do this non-traditional loan for a slightly higher rate. So do know that is absolutely an option as well. For these non-conventional loans and Fannie, Freddie, we can absolutely assist on vacation rentals as well, all the way up to $2 million for those non-traditional loan options. So definitely a cool product. Of course, as we covered, we can go over 10 loans. We can do no W-2 loans, no income really loans as well. You do have the ability to purchase in LLC names, and really for those investors that once again need low payments for those first couple years, those first 10 years, while they wait for that appreciation, that rental market to catch up really with the property values. We do have that interest only product, which once again, it's really exciting that all of these programs are coming out, just because I think it shows broader confidence, obviously, in what we are doing as investors. So great news on that. And, I appreciate once again the opportunity to share all this information with you guys, and I will turn it over to Joe.
All right. Well, thank you very much, Richard. That gave us a great overview of all your offerings, and you have quite a lot of options that could give our investors more opportunity to buy property. So just for everyone's benefit, when RealWealth brings in a new lender or a new supplier of anything, we vet them, and we got very positive reviews from Richard, from our Jacksonville team. They say nothing but great things to say about Richard and his business practices. I've been working with him personally for years, and he has helped hundreds of our clients with loans. He recently started his own branch at Supreme, which gives him a lot of flexibility and ability to lend outside Fannie Freddie guidelines. And so that's what we like. We have more options to offer our investors. If you can go to the next slide. Okay, what's next? If you want to talk to Richard, you can email him at richard.advani@supremelending.com or go to his website, richardadvani.com. Also, he's posted on our website. If you look on our investor portal in the lower left-hand column there where the red oval is, he's listed under both lenders and non-conventional lenders because he does offer both. So you can find his information there. Oh, by the way, further up on that menu, you see where it says webinar replay, about a quarter of the way down. That's where this webinar will be posted by end of day tomorrow. So if you look under webinar replay, recent webinars, tomorrow you'll see this webinar again, so you can watch it again. Or if anyone you know missed it, you can send them that link. All right, next question. So let's go for some FAQs here because this might answer a lot of it. We got some questions coming in, but these are top level questions we'd like to answer. So how is it that you're able to offer these kind of non-conventional loans and a company like Wells Fargo is not able to? Like, why is that?
Absolutely, yeah. So we work with a lot of non-traditional investors on the back end. Obviously, Wells typically stays in that QM space. A lot of the funding for these non-traditional type of options do come from hedge funds and really the secondary market. So keep in mind, although Supreme is a direct lender and we do Fannie Freddie, we have the option to work with multiples of lenders in kind of almost a broker status.
Okay, and where does Wells get its capital? Mostly from investor deposits?
Well, yeah, the traditional loans, of course, Fannie Freddie come from Fannie Freddie, but the jumbo and loans that they do offer and portfolio loans do come from deposits typically.
Okay. All right. After you finance a property, do you service the loan after it closes, or is the loan sold to someone else for servicing?
That's a great question. We often transfer servicing. We used to retain servicing, but as a lot of you know, earlier this year, Fannie Mae and Freddie Mac announced a 7% cap on delivery of investor loans to them. So what we've seen is a lot of lenders, including us, started kind of spreading out those investor loans. That way we don't hit that cap and we're able to still offer financing to our investor database.
Okay, I'm not sure what this next question means. What are the projections for current rate market? I guess what's your take on interest rates? Are they going to stay low or are they going to go up?
Of course, and I know Joe, you're thinking the same thing. That is obviously my opinion. I'm not an economist, but um, the general take from that you hear in the industry is rates are going to stay pretty low throughout the end of the year. My opinion is, prepare for maybe an increase in the next 6 months of 1/4 to 0.5% on rate. But even
Uh-huh.
if that happens, I mean, we're talking about going from 3.5 to 4%, which is still ludicrous. The lowest you can get investor rates a year and a half ago were like 4.25, 4.5. So even if we go up 3/8%, 0.5% from now to the end of the year, in my opinion, we're still historically really at the bottom. So are we all going to wake up in December on Christmas morning and see 7% rates, 6% rates, 5% rates? I don't think so, but fingers crossed for all of us.
Yeah. Well, I read somewhere that the government has so many trillions of dollars of national debt now that if they let interest rates go up by 1 percentage point, that's going to add 285 billion to the budget deficit every year. So they kind of painted themselves into a corner. They kind of have to keep rates low. All right.
Agreed.
And when you give these loans out, how long can you lock the rate for?
Another great question. Typically, you can lock up to 4 months on these loans. Once you exceed 90 days, you generally do need to pay an upfront fee for that extended lock period. That's a policy you'll kind of find across the industry.
Okay. All right. Next slide, please. All right. Audience questions. We got a few here. There's a couple about your LLC program. The interest rate was a little bit higher. So one enterprising investor would like to know, can you buy the house in your name to get the lower rate, and then after it closes, transfer it to the LLC's name?
So that's a great question, and that's something we get quite asked quite often for Fannie Mae and Freddie Mac loans.
Mhm.
Fannie Mae officially, I think about 3 years now, released an update stating that they themselves will allow people to transfer title to single member LLCs for asset protection purposes. And that is really up to the servicer from there on what they wanted to do. And I can tell you, even at working at Wells for the past 10 years, 2.5 years ago is about when the change happened. And there was no official word even from Wells about whether we were greenlighting it, but people were doing it and weren't necessarily running into any issues. Now, we at Supreme, the first thing I checked when I came over here was that question with our legal department was, hey, do we allow, Fannie allows it, do we allow transferring of the property to an LLC after closing? And the answer was yes. However, it is important to note, as mentioned earlier, a lot of lenders are and may transfer servicing of your loan to stay under that 7 to 10 Fannie Mae cap. So although we allow it, if your loan does end up somewhere else, they may or may not. So I want to be very clear about that. And that's something that we ran into, of course, because we were retaining servicing on 95% of the Fannie Mae loans before. And I was advising people that they can. But right now, we can't really tell in advance of whether we are going to retain or not. So
Hmm. Okay.
double check with the servicer at that point is my advice. But overall, my hunch is you should be able to. Fannie allows it. Most lenders are allowing it.
Yeah. Do you think you'd be grandfathered in? Okay. Tanya would like to know, can the LLC be newly formed and still get the
Yes,
loan?
absolutely.
LLC loan. Okay.
Yep. There is not, and keep in mind for the LLC, you still are personally guarantoring it. So yeah, an new LLC is not a problem because you are once again associated with the transaction.
Okay. Uh, some questions about refinancing. Is there a minimum refi amount?
Typically, ours is 40,000. I did get an exception last week for 38,000, so very close to it. But our minimum loan amount's pretty low.
Okay. Uh, Nathan would like to confirm, when you do a cash out refi, is that at the same rate or is it slightly higher than if you just got the loan originally?
That's a great question. So industry-wide cash out rates are higher than purchase rates, for example. And then so the kind of the way it goes is purchase rates typically will have the lowest rate.
Mm-hmm.
Rate and term refinances, non-cash out refinances have a little bit higher rate than a purchase, and then cash out loans typically will have a little higher rate than the non-cash out in the purchase.
So what's the difference between a cash out and a purchase rate? Maybe a quarter or half a point?
Generally closer to 3/8 to 0.5%. Obviously, reach out for a specific quote, but if you're looking to approximate, yeah, anywhere between 1/4 and 0.5%.
Okay. John would like to know for your cash out refis, what loan to value will you refi for?
Absolutely, 75% for single family homes. And if you have a 2 to 4 unit, you're generally limited at 70%.
70%. So you have 30% into it. Okay.
Correct.
All right. Carla would like to know, are any programs for SFRs owned by the IRA? I think you covered this, but you want
No, unfortunately, we do not have any programs for properties owned by an IRA or 401k.
Okay. Let's see. Brendan would like to know, on your 1031 program, can that apply to DSTs?
Can you clarify a little more?
DST, what does that stand for? I'm drawing a blank. It's basically like a syndication that you could set up so you could 1031 into it.
Got it. No, I do not think so.
Oh, okay.
I'll have to double check that one.
Let's see if we got any more questions. We might be done early today. Property in the DST.
Does that mean I was talking too fast in my presentation?
No, went through it all. Can we use IRA funds for down payment? You kind of addressed that.
Yes, we absolutely can use IRA funds for down payment. Obviously, check with the tax impacts and everything else, but on our end, IRA 401k funds are an acceptable source for down payment, yes.
So does that involve commingling of IRA funds and non-IRA funds, or does that cause
absolutely.
any problems? Yeah.
No, it does not. Nope, not at all. We can absolutely, you can have half the down payment, for example, coming from an IRA, and the other half coming from your checking account, and that does not pose an issue.
Okay. And when you do the IRA, when you say IRA loan, do you mean literally take money from the IRA and use it as a down payment, or borrow against the IRA balance to come up with a down payment?
They can do either. Obviously, the best path for tax purposes and retirement purposes, double check that. But yeah, whether it was a loan from a retirement account or funds from the retirement account itself, we can absolutely assist with that. What we can't assist with is the IRA itself buying the property, meaning the ownership of that property is under the IRA. That is what we cannot assist with.
Can't do. The title has to be in a person or an LLC. Okay. Carlos would like to know about the BRRRR strategy. Because of the prepayment penalty for 3 years, this doesn't work for the BRRRR model. Is that correct?
Well, I mean, most of the time for BRRRR properties, a lot of times at least people are paying cash initially. And then of course, you renovate it, you refinance it, you cash out, and at that point you're getting the loan with that penalty. So it wouldn't prohibit you from accomplishing BRRRR. But it would obviously prevent you from selling it or refinancing it after you took that loan from us. But just again, to be clear, if you buy a property in cash, you renovate it, you refinance it through us, that is something you can absolutely do. It's just you are going to have a prepayment penalty moving forward from there.
And what was the prepayment penalty again?
Generally 6 months of interest. So it's not, depending on your particular loan amount, it's not a crazy amount of money, but obviously you want to take that into account when making a decision.
I just remember DST is a Delaware statutory trust. So
yeah, I just pulled it up in front of me as well. I don't know why I didn't click on the moment. But from my understanding, we should be able to. I will get confirmation on that. I've not personally dealt with that. So I don't want to give any incorrect information, but whoever asked that, please follow up with me afterwards, or I can get your information from Joe and make sure to get that question answered for you.
Okay, great. Let's see, Rory would like to know, since this is for short-term rentals, since it's based on market average rental income, are there any other documents such as tax returns required? What do you have to do to get the short-term rentals?
So the short-term rental loans, whether it's Fannie Mae or this non-traditional program we spoke about, there really isn't anything different from a long-term rental. Lenders aren't looking at qualifications differently. There's no, special interest rates either. The only difference is for conventional, obviously, when you're using rental income to qualify, they're going to use a 1-year lease as the amount of rental income that you can qualify off of, whereas our non-traditional program actually does pull short-term rentals to determine that particular qualified monthly rent. So yeah, you don't have an issue with the short-term rentals on that program at all.
Okay, here's a question from Paul. With the interest-only loan, is there an early prepayment penalty?
Yes, there is. That is part of the non-traditional program, so those will have 3-year prepayment penalties.
Okay, I think we're running out of questions here. Oh, what's this? Benjamin.
Actually, one thing to note on that, Joe, is there is a way to buy out the prepayment penalty when we start the loan. And I know you guys got a couple of those questions. So for investors that are looking a little more short term for this financing, you generally are going to take a premium on your interest rate, of course. It could be quite a big premium if you want to, you can drop it from 3 years to 2 years or 2 years to 1 year. And I have to get specifics on that, but I think every year you drop is about 0.25% in interest rate. So there is a way to get rid of the prepayment penalty, but it's not something you want to leverage for the long term and take that higher rate.
Okay, Ben would like to know about jumbo loans. Your non-conventional loans, does the jumbo loan limit still apply? 548,000.
No, it does not.
It does not, because I remember you said 2 million. You lend up to 2 million?
Correct. On the non-traditional program, absolutely, we will.
Okay, so that's why you're doing a lot of our short-term rentals, because they tend to be expensive.
Absolutely.
All right, any other questions? Can you clarify why your non-conventional loans require that the borrower own their own primary residence?
Yeah, so, and keep in mind that these rules are really made on the broad level perspective, but let's say you live in Los Angeles and you were trying to buy a primary home and you couldn't qualify because your debt to income ratio was too high or whatever it means, and you were renting. There's a chance, if you didn't have to own a primary home, that you can apply for this loan, put 25% down, say you're going to rent it out, right? And this has no doc, right? And there's no real qualifications. And then now all of a sudden you put 25% down, you bought this house, you move into it, and we lent it on the premise that obviously it is going to be an investment property, and that was the whole premise for offering the loan. So some people could use this loan if you didn't own a primary to cheat and be able to buy a primary home. So it's kind of a hedge to make sure that, once again, people are using it truly to buy an investment property. Now, I didn't want to say it earlier to confuse things, but it is possible to get an exception on that as well. That investor I mentioned earlier that we did his 47th, 48th, and 49th property, well, he didn't own a primary home. But, I mean, when they looked at a guy with 45 to 48 properties and he was buying a property across the country, it was very clear, he wasn't going to move there and he had lots of experience. They did make an exception. So exceptions are possible. They're not likely, but if you have 50 properties and you don't own your primary, yes, please come to us because we will fight to get that exception for you.
Okay, so you either own your primary or own 50. Okay. Carla's question, I think we covered this. Do you lend everywhere in the U.S. or just for Jacksonville?
Oh, no, we loan everywhere in the U.S. Currently, we don't lend in Hawaii.
Yeah, every place except Hawaii. Okay. So all of the RealWealth network markets.
Absolutely, yes.
I don't understand this one. Can we get the non-conventional loan for the first investment property if it's a short-term rental, or do you have to wait until you have 10 other properties to qualify?
That's a great question. No, you don't. You do not need to have over 10 properties to qualify for the non-traditional program. There is one thing to note, though. let's say you have 5 finance properties, Fannie Mae, and you come to get one of these non-traditional loan products. When and if you go back to Fannie Mae for your next property, this still will count towards your 10 limit as far as Fannie Mae is concerned. So once again, you have 5 properties, you utilize this non-traditional program. As far as Fannie is concerned, now you have 6 finance. So this loan will count against your 10 limit if you utilize it.
Okay. Ben has a similar question to the one before. Do you have a minimum loan amount? The other question was about refinances, but in general, do you have a minimum loan amount?
Yeah, so for the traditional program, the Fannie Mae program, our loan amount's about 40,000. We can go slightly under. For this non-traditional loan program, which once again is the over 10 finance, the low doc, the interest only, and so forth, we do have a minimum loan amount, and it is 75,000 for that program. It also is important to note that the minimum is 75,000. However, once you go below 100,000 for your loan amount, you are required to be at 65% loan to value. And once again, this is the non-traditional program. So over 100,000, you can put 20% down. Once you go under 100,000, you have to put 35% down, and the minimum loan amount is 75,000.
Okay. Do you have a sheet with all this written out?
Yeah. It's I mean, the general guidelines obviously are very easy to convey to people, but we try to work a little outside the box. So the outside the box scenarios obviously are not quite as easy to put down on a piece of paper, but we absolutely can.
All right. Israel wants to know, do you work with investors seeking to buy their first buy and hold property?
Yes, absolutely we do. A lot of our mutual clients obviously are brand new investors. And I particularly like working with new investors because I was a new investor myself at some point, and I didn't have the RealWealth network and other, obviously learning avenues. So I made a lot of mistakes, and it's nice being able to help share information with people. That way they don't make the same mistakes that I made, and I'm sure a lot of people made. So yes, we absolutely do.
Okay. Here's an interesting question. On your 40-year interest-only product, basically it's interest only for the first 10 years, and then after that it reverts to a 30-year, right? Suppose someone wants to convert it before the 10-year point. Like, let's say 3 years into it, they want to convert it from interest only to a 30-year amortized loan. Can that be done?
That's a great question. Unfortunately, no. So the note terms that you sign at the beginning are kind of going to last for the whole loan. However, you're always welcome to send in some extra principal, right? So you can on your own start paying principal at that point as if it was a 30-year fixed. But officially on our end, you're not going, there's no way to say, hey, you know what, switch it to 30 years now, I'm done with the IO portion. It would stay a 10-year IO, and then of course 30-year AM.
I see. Okay, makes sense. Let's see, any other questions? We answered this. Gary wants to know, do you have any programs for multi-units above 5?
Unfortunately, no, we do not. I know Joe and them probably have great sources that can help with that, though.
Yep. All right. What if I'm in the process of selling my primary residence? I'm not sure what the question is there.
Well, they want to know, hey, you say I need to own a primary, and what if I'm in the process of selling it? I got asked that yesterday actually as well, so it's a good question. Unfortunately, it probably makes you prime target for someone who would, try to use this non-traditional program to buy a primary. Let's say that you were buying a primary after that, right? You're selling and moving. Well, there may be a 30 to 45 day gap where you couldn't utilize the program. But with these non-traditional programs, our underwriters have the ability to use their brains a little more, So let's say you sold your home in California and now you're renting in California, you're trying to buy a rental in Florida across the country. I think we can maybe talk some sense into them. That, hey, yeah, they're renting in California. We can see that. Here's their lease agreement. They're not trying to buy this property in Florida to really go live in. So once again, those case by case basis we can explore.
Okay, we'll wrap this up. Final question. Can you qualify for non-QM loans if you don't own any property?
No, unfortunately you can't. Yeah, you do need to own a primary or have a big rental history and experience.
Okay. Oh, one more just came in. Eileen would like to know, do you offer no income cash out refi loans for primary homes?
No, unfortunately not. We do offer obviously the no income cash out refis for investment properties, but unfortunately not for primary homes. For your guys' primary homes, we do have like bank statement programs and for self-employed people versus, the traditional lender is going to look at your tax returns. We can look at 12 or 24 months of bank statements. So there's a lot of creative things we can do. Feel free obviously to reach out to me and we can explore those.
Okay, this is a tax question. On an LLC loan, the individual's on the hook for the loan. Is the interest tax deductible on the individual's personal tax return or on the LLC's tax return?
Well, to clarify, Joe said I'm not a tax professional. Consult your tax professional, but from my experience, it depends, right? So most LLCs flow through to your personal tax returns, which means you're going to declare that property on your Schedule E of your personal tax returns. Now, some LLCs do have all LLCs have the option to actually file as a corporation, right? So it's an LLC filing as a corp, where you do file your actual independent business tax returns. And in that case, the interest is deducted through the LLC itself. Either way, you're getting a credit for it, of course. But consult your CPA. If it's a traditional LLC, typically is going to flow once again to your personal Schedule E, where you will write off that interest.
All right. Most LLCs are single member for investment
Correct.
purposes, so it'll just flow back to the individual's tax return. Okay,
Correct.
that's it for questions. I guess that does it. Thanks again for attending today, Richard, and presenting and offering these new products to our investors. Just a reminder to everyone, Richard's information is on our website under conventional loans, lenders, and non-conventional lenders. And this webinar itself will be posted tomorrow by end of day on the instant replay, recent webinars section of our website. All right, I guess we get to finish early today. Thanks everyone for attending, and hope you got something worthwhile out of the presentation, and see you next week. Thank you. Bye.